Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. I want to thank everyone for tuning in, all of the support. Great to be back on YouTube. There's been a lot of comments in the comment threads talking about options, exactly what I'm doing to make income on the portfolio. I've been doing a series of videos each Friday going through all of my weekly options trades, getting around 4,000 or so per week on options trading. So it's been quite profitable. But a lot of you guys have not been in options before, have not done contracts. So I thought I'd go through, start a new series talking about exactly what I'm doing, and starting with one of the easier contracts to understand, one of the simplest to enter, and that is a covered call. This is a great way to monetize buy and hold stocks you have in the portfolio that may or may not have dividends. You can get an extra dividend, extra income by simply holding it in your portfolio and doing nothing else. Again, monetizing the buy and hold strategies that a lot of investors like, the lower risk strategies where you're not going to necessarily lose your money overnight with some of the high risk swing trades or day trades or other types of options trades that you can enter into. So let's go ahead and talk about that today. A covered call. If you can see on my portfolio here under options, I have a lot of these. Anything that you see here with a sell call. So for example, Boeing 255 call, 12 sells. This is a covered call. CGC as well. I have some puts in there as well. We'll talk about that on another video. Let's go down to forward to show you exactly, again, how I can make extra income on stocks I have in the portfolio that I have no intention of selling. Buy and hold stocks that I can get an extra dividend for, again, simply by holding the stock in the portfolio and doing relatively low risk trades. So you can see here, Ford Motor Company currently trading at $12.84. Let's take a little look at a longer perspective here. 1 month, 3 months, and 1 year. So you can see here over the last 1 year, up 83.17%. I got lucky, decided to double down in this area here. And because of that, I have a nice return here, 104.45, over $100,000 profit on Ford Motor Company. Let's take a look at the last year here and show you guys exactly what a covered call would be. Again, you have no intention to sell the stock off, but you want to make extra income on those buy and hold stocks. So right now it's trading at $12.84. But let's, for example, say you bought the stock at, $8. Let's say the stock hypothetically is at $10. Let's say you want to put in a trade to make extra money. So you can put it in a contract saying you'd have to sell it if it gets above $10. If the stock trends up above $12, you have to sell it off. If it doesn't, the expiration simply expires and you keep premium. You keep that extra dividend. If the stock does get up to your price, you have to sell it off for that price. But because you bought here at $8, the current price is $10, it trends up to $12 or $11, you're still making that $8 to $11 gain plus the options premium. So you're not really going to lose any money if the stock trends up. If the stock trends down, obviously you have that in your portfolio, you're going to lose money, but you had no intention of trading the stock in the first place, so it's not like you're losing money by doing the options contract. The only thing I would say is that when you do get into a contract, you have to buy the contract back before you want to sell off your shares. But save that, you're incurring no extra risk by having a covered call on your stocks. Buy and hold stocks in the portfolio that you're making extra income on. And that's how I'm making most of the income on my portfolio. Around $4,000 per week so far over the last few months of trading. Let's go ahead and do trade options here. Let's go through exactly what we're doing here. There is a nice little overview here, if I can get that to pop up, with options contracts. This is great for new investors that initially get into this. You can see if the stock is going up, there's a number of trades you can do. If the stock is going down, there's a number of trades you can do. If it may go up, may go down, there's a number of trades. If it stays the same, there's a number of trades. So you can see here quite quickly, this is getting very, very complicated. These iron condors, iron butterflies have multiple trades. It's not one contract, it's a series of contracts, and they all have to be correctly configured. Likewise for straddles or strangles. But let's do this category here. I think it's going down. Again, I don't think that this is the case. You actually want the stock to stay the same or trend up slightly, so you make a swing trade profit. You don't want it going down, otherwise you're going to lose those stocks you have in the portfolio. But regardless, let's go ahead and do this sell a covered call here. Let's open that up. A little bit more learning for you guys here. What is a covered call? It goes through all of the terminology up on top there, just very briefly. Selling a covered call means opening a contract that gives you the obligation to sell shares of a stock at a particular price. shares that you already own and have in your portfolio. So this is an obligation. If you sell a covered call, you have to do this no matter what. You can't later say you don't want this to happen if the stock starts trending up dramatically and you don't want to sell it for the strike price, which can be very much less than what the current stock is trading for at that time. Important terms here. Again, we'll go over these in other videos. Strike price is when the price of the stock triggers the contract to execute, and the set date for expiration is the expiration date. That's when the contract, if it doesn't get up to that price, it simply expires. You still keep that premium, and then you can do the next contract the next week, another established position. And again, that extra dividend that you receive is the premium for selling the contract. So you get that extra dividend, extra income by establishing a strike price, hoping the stock does not get up to that price. And then by an expiration date, that's when the contract will expire on the stock, and you can enter into a new position after that. There's a few other terms here to keep in mind. Again, we'll go through all of these with an example, and we'll do this throughout the video series. In the money, at the money, and out of the money. Very important to take a look at these terms. In the money, the stock price is above the strike price. That means that that contract will execute. If it's at the money, the stock price is same as strike price. Typically, those do not execute, but they can. But they, in my experience, will not execute. And out of the money, this is what I do. The stock price is below the strike price. So you get income on the portfolio, on that stock. Nothing happens at expiration because the stock price is below the strike price in which you're willing to sell it for. You keep the premium, and then you simply repeat that the next week. Again, that's how I'm making all of the money on the portfolio. Those videos I put out on Friday, $4,000, $3,000 per week income. That's exactly what I'm doing with the portfolio. Let's go through an example here very quickly. Again, you can see up on the top here, these are all the expiration dates. The contracts will go to a certain point, as well as in each of these categories, you can see there's a number of strike prices that you can potentially enter into. Let's go down here where the stock is, or it'll be another little tab here. You can see currently the share price is $12.83. So if you see anything above that, for example, that $13 call for 32 cents per stock, each contract is 100 shares, so that's $32 that you get credited to your account. That would be something that is out of the money, because the share price is $12.83. You're willing to sell at 13. Since the strike price 13 is above the share price $12.83, that is out of the money. Below that $12 call, for example, you get 98 cents per share, $98 per contract. If this were the expiration date, you would have to sell the stock off at $12, even though it's $12.83. That's why somebody would buy the contract to make that difference. But you'd have to sell the stock off at $12, losing that potential profit there, 83 cents. But you do make 98 cents, so your break even is $12.98. So you're still making money on that trade. Unless the strike price, the stock price to get above $12.98, you'd still make money on that trade. Let's go ahead and do what I'm doing here. Let's say you want to do a covered call at $13. Let's open that up here. And I do like Robinhood as well. It has some nice graphics. If we open this up here, you can see exactly what's going on. So current price is $12.83. This is your strike price, 12. So if the stock does not go from $12.83 up until this point here, nothing happens. The contract expires, disappears. You keep the premium. You can see that the expected profit there, $32. If it starts getting above that, you're going to have to now sell the stock off for $13. So if it gets up to $13.10, you still have to sell at 13. So a potential loss of $10. And you can see here now the profit goes down to $22 because of that. And here's the break even. The stock would have to get up to $13.32 here before you start losing money, because that 32 cents is the price that you got back here for the premium. If it gets above that, then you're potentially losing money on the overall trade. But again, let's say the stock is at $12.81, but you bought it down here for $12.58. You're making money no matter where it's sold off at this point. You're simply going to lose potential profit here. So you still keep the premium, you still get the profit for the stock, and overall you make money 3 ways. You can make money actually 4 ways. If the stock has a dividend, you can make money. The swing trade, either short-term or long-term, because you bought down here and you're selling for up here, and you're getting the premium as well. And then you also can get some other extra income by doing a put contract to establish another position. But again, we'll talk about that on another video. So this is the way that I'm making most of the money on the portfolio, on the Robinhood portfolio. is by doing these covered calls. Very easy, very safe, and if they do execute, you're simply selling a stock off for a positive swing trade on a position that you had in your portfolio anyway, so you don't lose any money and there's no extra risk by doing this strategy. I hope that made sense. I wanted to quickly go through this. If that did not make sense, let me know in the comment thread down below, and I'll do an updated video addressing any of your questions or uncertainty on exactly what we're doing with this trade. In another video, we'll talk about exactly what price points are good to enter into for these particular trades. But not to make the video too long, I'll kind of end it there. Again, if you guys enjoy the content on the video series, if you guys enjoy and video content, please let me know in the comment threads down below. Please share, like, and subscribe. Until next video, we'll see you then.